Welcome back to Rock Stock Channel. It is Friday, September 26th, and we're back for what is now going to be an every 2 weeks Rock Stock recap. I'm here with Matt in London and Rodney. Where are you, Rodney?
Cape
You're in
Town.
Mauritius? You're in Cape
Cape
Town.
Town.
You're in Cape Town. Okay. Great. 2 months ago, Matt, we announced Matt joining us, and the title of that will flash up here was the super cycle is here for mining equities, commodity equities. And I've been saying, actually, since Optimistic Thought, our first video under Trump, in January, but then during the Liberation Day in April, when the markets crashed, I compared Liberation Day to, COVID, which was 5 years ago, in March, in terms of a supply chain disruption. And I suggested that 6 months later, during COVID, it was Tesla Battery Day in September, and it began a very big bull market. So here we are, September 26th. The September 22nd was Battery Day 5 years ago, and we have, if you remember, Elon Musk was saying mine more nickel. Then he started talking about lithium, and he started talking about clay and lithium. And here we have. I've also talked about Trump in the critical mineral space has everything else but lithium has been doing well, uranium and all sorts of esoteric ions that you can't pronounce. But the moment he'll mention lithium, there should be a rally in lithium stock. So here we are. We don't have a full announcement out of Lithium Americas. We talked about it 2 days ago. We'll have some commentary there, but it has lifted the entire sector on very high volumes this week, in particular, stocks that have U.S. projects like Ioneer and Standard Lithium and Anson and a few others. But the overall backdrop for raising capital has been good. Lithium Ionic, a client of RK Equities, announced the $10 million raise, and they upsized that to $15 million. Surge Battery Metals, another client of ours, sought to raise $3.5 million. They upsized that to $5 million. So it feels like the lithium prices have not gone up, and Goldman Sachs actually came out with a report we're going to talk about here in a second that talked about lower for longer. So the fundamentals are not super strong in lithium in September, but they did perk up, in July and August. But at the moment, the Donald Trump's fundamentals is the thematic as it pertains to lithium. I will comment that with the government supporting MP in rare earths and supporting very likely Lithium Americas in lithium, a question is like, who's next, right? Another client of ours, the metals company, has nickel, manganese, cobalt, and copper, and they have been getting rhetorical support from the government, as we talked about in our most recent video with Craig Shesky. And there's a lot of activity and talks in DC. Could they be next? We'll see. So with that, as an opening, before we get into the question, I just want to thank RK Equity has actually now two new sponsors. One is USCF, an innovator in commodity ETFs. I'd encourage you all to watch our introductory video with John Love, recorded and published last week, and visit their website, uscfinvestments.com. And a second sponsor, which used to be a sponsor and is now a sponsor again, is Lithium Royalty Corp. Ernie Ortiz was on the program 2 weeks ago, and this is a publicly traded royalty company on the Toronto Stock Exchange, LARC, that owns a number of royalties, including on Sigma and two Argentine projects, Trey Q, which used to be Neo Lithium, and also the Mariana project, which is controlled by Ganfeng, both of which are en route or already in production. And we mentioned, I had a tweet here, Argentina is getting full-throated support from Treasury Secretary Bessent and Donald Trump at the UN, and that should be supportive of Argentine equities, including Lithium Royalty as a play for that, but also Golan, NOAA, and Lithium Argentina. And that could have been supported. Lithium Argentina and Sigma outperformed this week, I think, in line with the Lithium Americas enthusiasm. So with that intro out of the way, we got our, I was thinking about comparing ourselves to the All In podcast. I got my besties here, Matt and Rodney. I'm kind of the Jason Calacanis figure, Matt, maybe you're David Friedberg, and Rodney could be Chamath, and we'll have a rotating kind of in and out David Sachs person. But Matt, I forwarded you the Goldman Sachs report. Let's talk about that and lithium, and what do we think is going to happen from here?
Yeah, so I mean, I think Goldman's came out with quite an interesting report during this week. I think it's really interesting to contrast the global brokers who perhaps have operations in China with the local brokers who perhaps don't have operations in China. And generally, you see quite a different perspective on supply, particularly from China and from Chinese entities. And certainly the companies who are closer to the Chinese lithium producers tend to have higher production forecasts from China and from Chinese companies in Africa, and indeed you see that in the Goldman Sachs piece as well, and also higher forecasts for secondary or recycling demand, or sorry, recycling production of lithium, because I think people underestimate how much recycled lithium is actually coming out of China at the moment. It's a substantial amount per month already. I think Goldman's have got something like 300,000 tons a year out of China by 2030, which is obviously quite a substantial amount of material. I don't actually disagree with the Goldman supply demand work too much. It's sort of within 10 or 15% of my model on either side. And I think that the area where I do disagree with them is on, their forecast on pricing, because they're suggesting that the sort of the lithium balance over the next 2 or 3 years could be sort of like 35,000 tons in surplus. But in our experience is that 25 or 30,000 ton surpluses can get gobbled up really quickly if we get a demand shock. So they're using the context of a 25, 30,000 ton surplus to imply that lithium prices aren't going to break up and are going to continue to be flatlining from here. Now, I don't sort of disagree that I don't really see major catalysts for lithium prices to spike from here, but I would expect them to be on a sort of gradual improving track from here, not necessarily heading straight back down to where we've come from. So that's the primary difference for me. A relatively small surplus in the market could translate into demand shocks, which could translate into higher prices. But for the time being, I think the big thing that continues to weigh on prices is that the relatively high inventory levels. I mean, we're nowhere near the sort of level of inventories we were at in 2019, 2020 in terms of days of supply, days of consumption. But we're still quite a lot higher than we were when prices were really strong in sort of 21, 22. So we need those inventory levels to start to come down before you can get really sort of table thumpingly excited on lithium, I think.
Yeah, I mean, that's an interesting point, Matt, because I guess the part I was struggling with previously with Goldman's was the size of the oversupply relative to annual production, and you're now saying that's a different number. So it's interesting, the call on price versus that shrinking in the oversupply. I mean, we were talking like 30 whatever percent of,
Yeah, I mean,
25,
at times we've
30%.
been talking sort of 100,000, 200,000 tons of oversupply, but now they sort of seem to be implying that the oversupply is much smaller. And if the oversupply is much smaller, then then that brings the market much more towards balance.
Yes. So, Yeah, I think is I struggled a bit and agree in terms of that amount of oversupply. I guess inventories might play a role, but there's a lot less. It's, when you were looking at previous numbers, it looked like structural oversupply. That doesn't look to be the case anymore.
I mean, to tell you the truth, Goldman's balance numbers are actually a little bit better than the numbers in my model. I've got a little bit more oversupply in my model, but the Goldman's market balance numbers are a little bit lower than my numbers. And I think you can't say that sort of 25 to 50,000 tons on a market that could be 1.5 approaching 2 million tons a year is a substantial oversupply.
I listened to I'm a Goldman client, so I listened to the accompanying podcast that they had with this note. And you're right, Matt, they do have on the ground presence, and I think it was Joy Chang talked about a recent meeting meetings they had in Yichun province as well as in Beijing to understand policy maneuvers that are happening there. Before I get into that, I will say they're forecasting 3.2 million tons of demand by 2030, which so it's not like an under demand forecast, of which they're pretty bullish. BS with 600,000, so they're a little bit bearish. EV take up kind of globally, but they don't overall. Their forecast is not that big, but I think they're. And they also said they have an Australian analyst and he covers all the Australian, big cap listed producers. They don't cover this out of North America. So their commentary on Albemarle and SQM, et cetera, is weak. But for the most part, they're saying that the cost curve is coming down in Australia. They see scope for the Australian producers to come down from a current all-in sustaining cost of 1,000 to maybe, 800. And that's going to keep a lid on prices, in addition to the fact that they think that, around 12, 13,000 LCE, they think China lepidolite, and Australia, can just switch on and off like really quickly. And there's a lot of latent, capacity there. I said, where could they be wrong? They could be wrong if there's a demand shock, but they could also be wrong. And this gets back to Joy's comments, which I didn't fully understand. But she left with, it's still uncertain. The September 30th, the 7 companies, they have a reserve inspection report. And there were some other policies out of Beijing that were just, it wasn't clear that everyone's just going to get the green light and be able to produce very quickly. So there could be a surprise there, and we're waiting to see, what happens from that September 30th
I think
date.
this plays in with the blog I wrote last week, which was talking about the changing legislative environment in China. And, this focus that the Chinese government has now brought in on lithium as a strategic mineral, and therefore a focus on oversupply. And we're seeing this across a number of materials now, not just in lithium. We're seeing it in aluminium, we're seeing it in solar, we're seeing it in batteries. That the Chinese government is very keen not to overuse domestic natural resources and basically put them into products that are dumped for low prices in overseas markets. So I think that there's now much more of a focus from the Chinese government in reining in oversupply. And that's another reason why I'm, more positive on lithium and think that we put a genuine bottom in June in this cycle.
Thanks for reminding our viewers about that blog that you just put up. I'd encourage you all to visit blogs.rkequity.com to get all of Matt's recent writings, and that for more detail on that particular note, watch our last video, which was the entitled, is lack, an MP moment. But in that, he detailed his arguments there. And in addition to the China note, you did talk about aluminum and aluminum versus copper. I want to switch now briefly to talk about what's happened in the copper market. Does that change your view at all?
I mean, I think
Well, what happened in the copper
yeah.
market?
So what happened in the copper market was that Freeport's Grasberg mine in Indonesia was basically one of the biggest mines in the world, declared force majeure due to a mine accident, a mudslide, and they've cut 5 or 6% of their production for this quarter, but a huge percentage of their production for next quarter, which straight away opens up potentially a very substantial deficit in the copper market in the next quarter. So copper prices went spiky poos off the back of that, which is quite positive. That's obviously the technical term. The copper market tightened up quite strongly off the back of that. Now, I think the thing about copper, that sort of there's a difficult juxtaposition here. I think everybody knows that in the medium to longer term, it's very, very tight due to the strong demand story coming off the electrification, basically, of the global economy. So in the medium to longer term, it's very, very tight. I think the concern was in the near term due to the potential for economic slowdown in the US, further anemic growth in China, etc. And people were not quite sure how to trade copper, but obviously the issue in supply continues to rear its head insofar as the mining industry is really struggling to maintain its production forecasts. And this outage at Grasberg is just the latest in a long stream of undershoots by mining companies in terms of copper supply. So yeah, I know it's a big one. It's a big one. So I think the copper price is getting a nice bid on, and we could easily have a sort of a strong near term. And obviously there have been quite a few shenanigans in the copper market this year, particularly with around the tariff situation in the US. A lot of inventories, metal inventories that were sitting in Asia, have gone to the US to take advantage of the US arbitrage because of the expectation that the Trump administration would bring in tariffs on copper. As it happens, they then stepped away from that and suggested that they would only bring in tariffs on copper products. So we now have a situation where a lot of the inventory that was built on COMEX now is going to have to flow back to Asia, where there is a stronger demand market for it. So there's a lot of fun and games going on, from a technical basis in the copper market at the moment. And up until certainly the last couple of weeks, we hadn't really seen very strong demand for copper products in China, in Asia. Operating rates in the midstream and the downstream are not particularly high. It remains to be seen whether they sort of pick up into the end of the year. So there's a very interesting juxtaposition. Inventories are not elevated. They're about 10 days of supply. Contrast that, for instance, with lithium, around about 30 to 40 days of supply. So inventories are pretty low levels, but not as low as aluminium, which is around 2 to 3 days of supply.
Matt, have you seen, when you talk midstream, have you seen that in the tolling charges?
It's more. I mean, the tolling charges are a little bit. They have come up. So the tolling charges went to like zero.
I mean, they were literally, it was desperation, at one point.
Because there was a huge undersupply of copper concentrate. They did slightly come up, given that the Grasberg accident is primarily copper concentrate. I would expect them to fall again, because it will take concentrate out of the system. We're obviously also dealing with the fact that China's put quite a lot of copper smelting capacity on over the last couple of years as well, which has tightened up the market too. But no, the operating rate I was referring to was sort of copper semis, copper wire, etc.
There also, one other thing, I guess, with Grasberg, but we don't really cover it, is it also produces about 1.5% of gold supply for the year.
Yeah. And if gold moves on fundamentals, that would be positive. But it's just another positive data point on gold, I think, at the moment.
So I've owned the copper ETF, the Global X ETF. We mentioned actually in our USCF video that they have a way to play on the copper price, CPER. So I'd encourage our viewers, if they're interested in and just playing the copper price, that's not correlated so much to the equity, just the price. But
I mean, and the nice reason to go for a copper ETF or a copper physical ETF rather than a stocks ETF is, as I highlighted, the mining companies haven't covered themselves in glory with regards to hitting their production targets. So by going for an ETF that's entirely based on the futures market, you obviously give yourself leverage to that move without taking on operational risk from copper producers. Because I'm sure that, every ETF in the world has probably got a big proportion of Freeport in there, because it is one of the biggest miners in the world in copper.
yeah, again, by the way, we talk about stocks here, but again, for everybody, we're not financial advisors, so nothing in this video should be considered investment advice. But sometimes we talk about our clients, sometimes we talk about our shareholdings that are not our clients. In the case of the COPX, um, it uh, it did go up, even though FCX is a big portion of it, but maybe not as much as it otherwise would. But I am seeing people like Pamplona Trader, on Twitter, and the Koala, started touting, Anglo, and Ivanhoe Electric, Ivanhoe Mines, and the Copper Bull is just, kind of beginning. So I actually increased my position in COPX this week on this FCX news, and I am looking at those three stocks that my friends I respect, and maybe some other copper juniors. I think Matt, you saw one. We both have been looking at a few.
Yeah, I've got some interesting copper juniors, but probably a discussion for another time.
Yeah. Okay. Um, but to a broader point about funds flows into commodities generally, the fact that gold continues to perform well, the GDXJ, financial advisors, like I have one at Morgan Stanley, uh, you know, are, as each quarter goes by and they say, "Oh, what's your allocation to commodities?" Most people are very underweight commodities, but now it's not just gold. VanEck, rare earth and materials fund has gone up. Copper, uranium, lithium, the LIT. I think this just that there's an element of technical factors trumping fundamentals and funds flows into these very small markets, because you're getting so much commentary in the press about it regularly. Hyperion X, which we just met, got another disbursement from the Department of War overnight, that supported that share.
I mean, I think the very important thing in commodities that's not really being picked up is that we are seeing a long-term sort of secular trend here. And I haven't really seen a secular trend this strong since 2001, 2002, when we were looking at the China super cycle. And it's not necessarily in all of the traditional commodities. So, maybe the steel market, the iron ore market is not going to be as robust off the back of this. But the commodities that are exposed to solar installations, wind installations, electrical connectivity, generating capacity. It's a really substantial event, and we've seen it to some extent in terms of the inventories. I mean, one of the things that was very clear in 2001, 2002, we weren't really looking for it, but the inventories got cleared out very rapidly, really in a space of like 6 or 9 months. And then prices moved very substantially after that. And we're starting to see it in terms of inventories in some of these, niche commodities, that the inventories got cleared out and then prices are really starting to move. And I think that we're in a similar situation with regards to under allocation to commodities as we were in 2002, 2003. 2002, we were coming off a sort of 20 to 30 year period of declining prices in real terms. A lot of major funds and major fund groups were not invested in commodities at all. And I think that's the situation we're in here. When we were in New York 2 weeks ago, somebody said something which I think was really interesting. But I think they said 85% of current US funds are in passive instruments. They're not actively managed funds. And, those passive instruments have minute or zero weightings in commodities. So we have a potential here, if the commodities markets really start to take off, where we could see a pretty substantial and exciting move in a number of these real commodities that are very much in demand for the actual physical development of the electrical economy, as it were. So yeah, I mean, I think in many ways I see the current environment as being very similar to what we saw in 2002, 2003. And obviously we know what happened in the 4 or 5 years after that in terms of commodity prices and commodity equities in particular.
And it's very, the US investor, the US retail, generalist, we're just a huge economy compared to Australia and Canada. There's just so many more people with so much money. If they allocate, just some more money here, it's just it's a massive funds flow, and they're not as informed as commodity countries like the Australians and Canadians. They invest thematically, and so we see a big everyone wants to list in the US at the moment. The volume, Lithium Americas traded $1.5 billion. That's equivalent to their market cap in one day. That happened. Piedmont traded 2 billion, off of a 200 million market cap 5 years ago, right? So this meme stock behavior, stock twits and Reddit are being added to the mix here of Twitter and LinkedIn, as getting excited about various commodity plays. But the fully listed US ones, especially if it's a US asset, are doing well. But the Canadian ones, we should mention, there were some site visits at Q2 and Patriot, now called PMET Resources, and also Alevra. A number of our friends visited those sites. Q2 stock has performed actually quite well, went over $1. I think they put out some nice pictures. Do you have any commentary, Matt or Rodney, on
Well,
the
there were some
Quebec
great
stories?
pictures of the 440 meter pegmatite intercept with like 20 people lying around it, and just to show the size of the intercept. So yeah, some really good pictures on there, I thought.
Looking forward to hearing seeing the assays. And
Yeah.
I forgot to mention, Rodney, a story. I'm no longer engaged with MinRes. I sold out a little while ago and pivoted to Pilbara, and a few others, because they're it's great company, but the Chris Ellison news, etc. And if I wanted iron ore exposure, I could get it elsewhere. Like I had enough. I was in MinRes largely for lithium, but they just refinanced their debt, $700 million in debt. I think it was at eight and an eighth
They did it at
percent.
7, I think.
They did
So
it
they
at
did it at
7,
7. So
right? Even
it's
though interest
interesting
rates
because I
have
did own the
risen.
debt. Yeah. Well, I mean, I guess it depends on the duration. So it was around a 5-year bond, I think. But yeah, I mean, I had previously owned quite a bit of the debt, and with the volatility, I fortunately got out before the correction. But now they've had a recovery, so the market clearly believes that there's enough. Even if people are tepid on lithium, there's enough in the iron ore and in the mining services to keep going. So they did well on the refinancing, but it remains quite a leveraged company, given that he discovered the US debt market and running on that and been selling hauling all roads and so on. So it is a leveraged play. If prices catch a bid, Matt, I mean, I have my view on Chinese property and property elsewhere in the world, and if you look at property on offer versus property bid and so on, it still looks, the major cities in China are improving, the second and third tier are not. Where are you on steel and iron ore?
Not as positive as you probably gathered. When I was in China in November, there was the feel that it could be a sort of 2 or 3 year event to sort of get inventories right sized and get these markets correct. So as always, the first and second tier cities will lead, but the third tier cities probably will take some catching up. And also I don't think that the Chinese property market will ever do what it did before. So it's never going to be growing at sort of 10,
Well, the
15.
population,
Yeah.
the demographics suggests,
Yeah.
unless you're building a lot of old age homes, that's not
Yeah,
the
exactly.
case.
And I mean, we've got a lot of inventories. I mean, when we went to China in November, whenever I go to China, I do a crane count, and you look around the horizon, and you probably see like 100 cranes. It wasn't like that in November. It was like you were lucky if you counted 10 cranes. So that's an indication of how substantially. And I keep a very close eye on the domestic excavator sales, which is a great leading indicator for what construction is doing there. And it's positive growth, but in absolute terms, it's nowhere close to what it was 4 or 5 years ago.
And I mean, you're seeing that a bit everywhere with truck sales and so on. Matt, your thoughts on how intensive infrastructure spend will be around AI or power generation in the US?
I mean, very, very, very intensive. I think the big issue in the US comes with regards to interconnectors. So if you can have captive power for your data centers or whatever, then you're all right. But if you're requiring power from elsewhere, then that's a real problem. And I think that's a reason why we're still seeing really strong solar installations in the US, because solar is the easiest and cheapest
Quickest.
power source and quickest power source to install. So solar and batteries, straight away, you can get in a power source to support your data centers, which otherwise you'd be waiting years for, potentially 5 or 10 years.
Matt, on that one, our often guest on the show, Iola Hughes, did a post talking about BYD and the energy storage, talking about a 2170 amp hour battery. So that's just in another league. Your thoughts on that and what that means? She mentioned cycle life, but I mean, it's now 14 point something, I think, megawatts, I presume, in a container or something. Your thoughts?
So it's 7 times the average size of a battery last year. So your average ampere hour best battery last year was about 314, I think. So it's seven times that. And if you can think about the efficiency improvement and the the lower bill of lading by having such a huge battery, and you don't waste space in your container, it's so significant. Now your 14 megawatt hour battery, probably all right in China, less good in other countries, because what we have been seeing recently is we are banging up against weight restrictions on batteries in terms of what can easily be moved on the road. And I think we are, your 7 or 8 megawatt hour unit is banging up against what can be moved on the road. So you are talking about sort of specialist installation, shall we say, which is not available to every single best project in the world. But it is, it's amazing when you look at, how substantially the BESS environment in terms of technology has changed just in the last 3 years, and what that means for solar plus storage and the economics of solar plus storage.
So just if we can refresh then, because we did discuss it, the new China policy is, in theory, I think 3,600 gigawatt hours by 2035. If you look at the current trajectory, if that keeps going, that could be hit by 2030.
That's what they're
Where are
saying.
you?
Yeah.
Yeah. So what are you sort of? I know you've looked at scenarios and so on. My view is 1,500 gigawatt hours for energy storage 2030. Your thoughts?
I don't think that looks unrealistic. Definitely not. I mean, I've got, I think, what have I got in my models? Let me just look at that. Yeah, I'm a little bit lighter than that, but only about 10%. And my numbers are probably 3 or 4 months old, so I will go in and have an update of my numbers before the end of the year.
Yeah, it doesn't
But
take much. It doesn't take
yeah,
too many decimal points to end up in the same place.
yeah.
What
But
what does that translate into in terms of LCE?
my best number at the moment translates um into 850,000 tons in 2030.
800. Okay, because I was just thinking the Goldman note was suggesting 600,000. So their best
Yeah, and
targets
I'm closer to a
undershoot
million.
you.
Yeah.
Yeah, and I'm about 1 million, so that comes out to the difference between me and
Okay.
Goldman's, I guess, in aggregate. Or
Yeah.
So they think
that.
they're bullish. They think they're bullish, but you guys are even more bullish. And Matt, I know
YJ
you're
is a
is
shooting star
outlier.
in the cosmos somewhere.
Yeah.
Well, he's similar to mine, but I think it's more his trucks that he's got. But
Yeah. I think the
if you
truck
look at
loading.
costing and technology, Matt, I mean, at the rate that we are, you've just said 7 times in one leap. So where
Yeah.
are we going to be in 5 years? It's quite conceivable we could all be wrong and under.
I think it is very conceivable on BESS. I mean, the only issues that I think we're banging up to on BESS is safety, in terms of fires. So you talk to a lot of the BESS developers, and I think one of the issues is that the technology of the batteries has moved forward so much over the last 5 years, but the technology of the battery management systems hasn't. So we need to see the software catching up. And we need to see, in China at the moment, for instance, there's a big move towards ensuring that the fire suppression systems are viable on these projects. In fact, China actually has world leading best safety regulations that don't really exist in other countries. So I think we need the safety technology to catch up before we take another huge leap forward in terms of the technology.
But you typically find that comes in cycles, so that's probably in the works.
Yeah, I'm sure it is. I'm sure it is. I mean, the Chinese regulations are actually now more stringent than any regulations are anywhere in the world. So and I think the Chinese have really got it right in terms of investing in their battery ecosystem, because what they said was, well, you guys go out and innovate technically first, get the industry on an equal footing, and then we'll worry about sort of bringing in regulations. And if you contrast that with the EU, which is like regulate, 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 and then you either have to dial back on those regulations if you want the industry to work, or you say goodbye to the industry, because no industry can operate under that sort of burden of regulation. So you've got to say, on the balance of what's going on in the world, the Chinese got it right, and the EU to some extent has failed dismally.
I want to turn quickly. It was a UN week here, and in connection with that, Climate Week. Trump gave a rousing speech at the UN, and immediately after that, Xi Jinping, announced China's 2035 climate target. So I'd like you guys to talk about that dichotomy in a second, but I will say we have talked about the concept of a grand bargain with China. There was news about TikTok, being sold, I guess, to Oracle founder Larry Ellison. So just like the MP deal on rare earths, TikTok was a big sticking point into what to do there. Trump announced that he will meet Xi Jinping, I think, at an APEC meeting in Korea, if I heard that correctly. And then they talked about, two other meetings in each other's countries. So there seem, I'm just noting that, there, that's the big kahuna of all the trade negotiations. Yes, he announced some additional tariffs on kitchen cabinets and and things like that, and pharmaceuticals yesterday. But actually, the GDP for the second quarter was increased from 3.3 to 3.8. The tariff worries don't seem to be playing themselves out just yet. AI, lots of spend on that. That's so. I mean, the backdrop is it's risk on, pretty much everywhere, not just in commodities. And the Trump deregulation policies and the beautiful bill that passed. As a catalyst, I'm hopeful. A grand bargain, is in place, and might it result in a CATL, BYD, or other companies. You flagged for me an article, or LinkedIn article, Matt, about how to someone suggesting giving good visas to selectively to Chinese entrepreneurs to build plants here in America. So if we could just end on the China versus U.S. climate and targets, and what does that mean for I guess the commodities and the battery EV and battery supply chain.
Well, I mean, I think to some extent, I do feel that the concern over the US walking away from the energy transition perhaps is a little bit overdone. Yes, the current administration are not fans of the renewable space, but as we were just talking about, there are areas in which the renewable space can't be beaten. So, for instance, if I want to build an AI data center in the US, I could wait 10 years for an interconnector to connect me to the grid, or I could take 18 months to 2 years to build a solar plant and a battery, and have my data center up and, have enough power to supply it within 2 years. So I think, there is private support for the renewables within the US. We talked already a little bit about the Chinese climate target. If China carries on at the rate it's going with its solar installations, it will hit its 2035 target by 2030 or 2031. So, I think we're seeing a very different kettle of fish in China, which is sort of setting targets that it knows it can beat, whereas the US is rolling back on targets. But as we had during the previous Trump administration, there's still plentiful support for renewables and for EVs from private companies. I don't know what you think, Rodney.
Yeah, I'd agree. I think.
Okay, I mean, that covers largely the docket that I had here. Do you have any other comments, Matt or Rodney, that we didn't cover yet?
Yeah, I mean, I think that Rodney has a really interesting perspective on the potential for increasing money supply to promote hard assets. So, Rodney, take it away.
Yeah, look, I've seen some, graphs around China M2 money supply and commodity demand. And if you look at how much liquidity they've been pumping into the system, it's likely that we're going to see a pickup in commodity demand. Is that likely to be X energy? Probably. So that is typically increasing in global money supply means a shift to hard assets, and hard assets, I think, the scope of hard assets is broadening beyond just precious metals. So I think we're likely to see a pickup. And
what about in the US, where obviously there's quite a lot of support going on for the US dollar?
yeah, I mean, again, I suppose in the US, when you're putting through money supply, the sponges for cash is definitely AI and that infrastructure around that. That's just absorbing a lot of money in the system. You've got precious metals for a hedge in central banks and, crypto, Bitcoin, and so on, that can swallow up that liquidity. In terms of housing, it seems to be unaffordable. Demand doesn't seem to be there. So I don't think in terms of construction materials we're going to see it, but definitely AI. And then, there's some of the minor metals that you've mentioned. I think in terms of those that are specifically focused, I'm not sure everyone's, some of these are quite niche markets, so people tend to overlook it, and generalists will overlook it. But I think you're onto something there, Matt, in terms of some of the more opaque and smaller, but are critical to the whole infrastructure and general demand, that those will, if one takes the time to drill down, those are probably going to be beneficiaries, because getting some of these things into production requires, especially if it's a byproduct metal or something else, then it's trickier.
Yeah. Well, we have a piece, have a blog article or blog series coming out about some of these minor metals in the next 2 or 3 weeks or so. And I guess I should also add that we've added a lot of these minor metals to our RK equity scoreboards. So if you do want to get an idea for the sort of movers and shakers in each of these segments, have a look at our scoreboards, and you'll be able to see going forward.
And on that point, that's a good thought. I was remiss in not publishing the lithium ion bull in September, but waiting until the end of the third quarter. So next week or so, we will be publishing the latest lithium bull. And if you want to get that directly to your email box, please go to the RK Equity website and register your email there. You could also reach out to us if you have any questions about any of the companies we've covered here. Reach out at rockstockchannel@rkequity.com, or ping any of us at RK Equity Rocks on X, or at Lithium Ion Bull is me, at Matt_Fernley is Matt, and at Rodney Hooper 13 is Rodney on X. And with that, guys, have a good weekend.
Okay. Cheers.
Right.